Welcome to Countats. In this lesson, we're going to be looking at the accounting equation, but where you also have the debit and credit column. So we're going to see how this one works. We have done a couple of lessons before on the accounting equation. We explained it simply on our first lesson, and on the second one, we went through some examples on completing the accounting equation. So here, we're going to do similar examples to that one, but here we have two extra columns where we have our debits and our credits, as I just mentioned. So if you'd like to check those ones out, which would be a great place to start, you'll find the links to those lessons in the description below. Another link you'll also find is one on the debits and credits, explaining what is debited and what is credited. And you'll find also another lesson where we give you tips on how to remember what account to debit and what to credit. Those ones will greatly help you in understanding this one here. So what did we say about the accounting equation? Well, the accounting equation shows all the accounts that affects the balance sheet, that is the statement of financial position, and establishes how each transaction relates to the balance sheet. This is a great foundation for an explanation of the double entry accounting system. In the examples to follow, we will show how each transaction is recorded as a journal, that is debits and credits, and how it will be recorded in the accounting equation. So let's get right into the examples and see how this one will look and how we'll do the accounting equation. So in this example, we have a number of transactions that we have to do. We are told that K Acre is an entity that uses the perpetual inventory system and had the following transactions during the month of August 2020. Now it's very important. They told us that they use the perpetual inventory system. That will come into play when we are dealing with the sales of inventory and the purchases of inventory. So any movement in inventory will be affected by the fact that the company uses the perpetual inventory system. Now we have done extensive lessons on those ones. You'll find the links in the description below. So we are asked here to complete the accounting equation showing the effect, and that's the plus and the minus sign, or the positive and the negative sign, and indicating which account is debited and which one is credited. And we are given the format here at the bottom. We have the number of the transaction, we have the account debited, account credited, assets, equity, and liabilities. Now we obviously know assets equal equity plus liabilities, and you can refer to our first lesson that I alluded to earlier. So let's take them one by one. We have 10 transactions here. Let's do them one by one. So let's take out the rest and do the first one so that we can have space. The first one says paid 2,000 Rand for advertising. Now whenever you pay for advertising, you know that there are two accounts involved here. The first account there is bank, because you paid, money left your bank account. And the second account is the expense called advertising. Remember, advertising is an expense, and we know which one is debited and which one is credited based on the lesson that I mentioned earlier on what you debit and what you credit. So here, what are we going to do? Well, we're going to put number 1, and we're going to have advertising as the account which is debited because we debit our expenses, and there we have it. And then the second account is the bank account that I just mentioned, and we credit it. Why? Because we are paying. So money is leaving our bank account. So whenever money leaves our bank account, we always put it on the credit side. So we put bank as the account which will be credited. And then what do we do on the asset side? Does it affect our assets, equity, or liabilities? Well, we know that bank is an asset and it's decreasing. Remember, assets decrease on the credit side. So if you've put an asset on the credit side, you know it's going to be a negative. So we're going to put the amount there, 2,000 Rand, but we're going to put it as a negative. And we're referring to the bank because money is leaving our account. So we put there minus 2,000 Rand. That's for the bank. And advertising is an expense. And remember, we record our incomes and expenses under equity because they affect our equity account. Now, your accounting equation may look a bit different, where the equity section is divided into income, expenses, capital, and drawings. So you put it there on the expenses column, but it's a minus. Remember, all expenses reduce our equity. So we're going to put there minus 2,000 Rand. It's important for you to remember, what is this 2,000 Rand for? Is it for bank or advertising? Well, like I said, the minus 2,000 Rand under assets is for bank, and the minus 2,000 Rand under equity is for advertising, which is an expense. We always put our expenses under the equity section, as well as our income if we have the income. So you can see our assets still equal our equity plus liabilities, because on the asset side we have minus 2,000, and then the equity we have minus 2,000 as well. We have nothing on liabilities, so we are still good. Let's move on to the second example. Here we are told we bought inventory on credit for 50,000 rand. Now, like I mentioned, any movement in inventory, whether we bought or we sold, we will record it based on the inventory system that the company is using, and we're told it's using the perpetual inventory system. So I hope you are able to check those lessons that I'm referring to in the link in the description below, which will help you thoroughly understand the perpetual inventory system and the periodic inventory system. We showed everything on those systems and how to do the transactions on them, so you can check them out. But here we'll briefly go through it. You bought inventory for 50,000 rand. Whenever you buy inventory, we have two accounts here. The first one is inventory because it's the perpetual inventory system. If it was the periodic inventory system, we would not be recording inventory at this point. So the first one is inventory, and then the second one here is accounts payable. Okay, we bought inventory, but then you ask yourself the question, how did I buy the inventory? Did I buy it using cash or did I buy it on credit? If you bought it on credit, that's accounts payable. Others will call it creditors control, or will call it just payable. So it's all fine. It's referring to the same thing. So what is the first one here? Well, we're going to debit our inventory. Why? Because inventory is an asset, and when we are buying inventory, it's coming into our premises, so it increases on the debit side. Remember, our assets increase on the debit side. So we put the number there, number 2, we put inventory, and then what do we credit? Well, we credit however we bought it. We bought it on credit, like I mentioned, so we put accounts payable. Remember, accounts payable is a liability, and liability increase on the credit side, so we put the accounts payable. And then what section of the accounting equation does it affect? Well, it does affect our assets because inventory is an asset. So we're going to put plus 50,000 rand because our assets are increasing by 50,000 rand. What else is increasing? Well, our accounts payable is a liability and it's increasing. By increasing, we mean we owe more money on our liability section. So we put the plus 50,000 rand. I hope it was simple enough. Let's move on to the third one. We're told here that we sold inventory worth 13,500 rand for 17,750 rand on credit. Now, we are using the perpetual inventory here again, so we'll have two transactions taking place here. Whenever you sell your inventory using the perpetual inventory system, you have two transactions involved. We're not going to go into great detail here because we went into great detail on our other lessons that I've been alluding to. So let's get into it. So the third one here, the first thing we record, the first transaction is on the sale of the inventory. So what are we going to record? We're going to record accounts receivable because our customers owe us. We sold it on credit, so it's accounts receivable. We are yet to receive this money, and accounts receivable is an asset, and assets increase on the debit side. So we put there number 3, and we put accounts receivable. And then what else is affected here? Well, we have sales. So we have accounts receivable, and then we have sales. So we're going to credit our sales. Remember, sales is an income, and income goes under equity, and income increases, or equity increases on the credit side. Okay, so whatever increases our equity will be put on the credit side. That is income. So we put here sales because sales is an income, and then we now put on the asset side. What is happening to our assets? Well, our accounts receivable is going up, meaning the amount of people who owe us, or the amount of money we are owed, is going up, and that is our asset. So we put the plus 17,750 rand. Remember, we are putting there the amount that our customer owes us, not the amount that we bought the inventory with. We're going to go to that just now in our second transaction. And then what do we do with the sales one? Well, we put plus 17,750 on the equity side because our sales is an income and it increases our equity. Okay, so that's the first transaction when we are dealing with the sales of inventory using the perpetual inventory system. The second one is to record what is happening to our inventory. Remember, when we sell our inventory, we are getting rid of our inventory, or it's going out of our premises. So our inventory will decrease. So then we have the cost of sales, which is an expense. Okay, how much it costed us to make this sale? Well, that is the price of the inventory. Well, we are told we sold inventory worth 13,500 rand, and that is how much it costed us. So that's the cost of sales. So we put down cost of sales. That is the account that is debited because expenses are always debited. Okay, and then the second one is our inventory. Remember, our inventory is leaving our premises, so we have to put that in our books. So put inventory there. And what is the amount? This time the amount is the one that we bought it for, okay? And it's worth 13,500 rand. That's how much you bought it for, or that's how much it's worth in our books. So we're going to put minus 13,500 rand on the asset side, because we've just credited our inventory, and inventory is an asset. It decreases on the credit side, so we put minus 13,500 rand. And then what else is happening here? We have cost of sales, which is an expense, just like the very first transaction for advertising. So they reduce our equity, so we put here minus 13,500 rand. I hope you can see how it works with the perpetual inventory, where you have two transactions, and how it affects our accounting equation together with the debit and the credit. Let's move on to the fourth transaction. We're told here that paid the supplier, it's supposed to be the supplier there, 10,000 rand for goods bought on credit. So we paid our supplier for the goods that we bought on credit. So what is happening here? Well, if we pay our suppliers, our accounts payable reduces. And where does our accounts payable reduce? Well, accounts payable is a liability, and they reduce on the debit side. So we put accounts payable on the debit side. And then why is it reducing? Well, because we just paid them, so our bank is reducing as well. Remember, when our bank is reducing, we credit the amount, just like what we did for our very first transaction. So we put bank on the credit side, or on the account that is credited, and then we put the amount as 10,000 rand. So our assets are reducing by 10,000 rand. So we put minus 10,000 rand on the asset side. And why is our bank reducing, or why is our asset reducing? Well, because we paid our supplier, so that means our liabilities reduce as well. So we put minus 10,000 rand on the liabilities side. And as you can see, for all the transactions we've been doing, our assets still equal equity plus liabilities. If you can see what we have on the asset side, it still equals equity plus liabilities. Always check for that after every transaction, if it's making sense, and if you've put the things correctly where your accounting equation still works. Okay, let's move on to the fifth example. We're told here that the owner took goods worth 4,000 rand for own use. Now, whenever the owner takes anything from the business for his own use, that is called drawings. And drawings is an expense account, or it reduces our equity, so we put it on the debit side. So we put the drawings as the account debited. And what did the owner take here? Well, he took goods, so that is inventory. Now remember, you can use stock, you can use inventory, you can use merchandise. Those terms are used interchangeably. So if yours says merchandise, don't be confused. It's still the same thing as inventory. Okay, so the owner took goods from the business, so we're putting the inventory on the credit side, because our inventory is reducing, because it's going out of our business. The owner is taking it, so put inventory there. And inventory is an asset, so our assets will reduce by 4,000 rand, so we put minus 4,000 rand on the asset side. And then drawings reduce our equity, so we put minus 4,000 rand on the equity side as well. I hope it's making sense. You can see our accounting equations still work. Our assets still equals equity plus liabilities. Let's move on to the sixth one. Here we are told that we received rent from a tenant, 4,900 rand. Now we received money from a tenant. So when we receive money, that's an easy one. Our bank is increasing, or our asset is increasing. So account debited here is our bank. So put that down. And then what do we credit? Well, we credit why we are receiving that money. We are receiving it for rent, and it's rent income. Whenever we receive money from our tenant or from our premises where we are renting out, that's rent income. So we're going to put the rent income as the account credited. Remember, that's an income account, so we credit all our incomes. And then from there, what do we do? Well, on the asset side, since we are debiting our bank and money is coming into our bank, our asset is increasing, so we put the plus 4,900 rand on the asset side. And then rent income is an income, obviously, and it's increasing our equity, so we put also plus 4,900 rand there. That's quite easy. Let's move on to the seventh one. Here we are told that we bought equipment by check, 28,000 rand. Now whenever it says by check, that's the same as saying we bought it using cash. So our bank is decreasing, that's the first account. But what is increasing? Why did we pay that money? Well, we bought equipment. Equipment is an asset, and you know that assets increase on the debit side. So the first one there we put is account debited, which is equipment. So we put equipment down. And how did we buy it? We bought it using cash. So we put down bank as the account credited, and bank is an asset as well. So what is happening here? Our equipment is an asset. It's increasing because it has just come into our premises because we bought it. So we put the plus 28,000 Rand on the asset side. But what do you see on the credit side? On the credit side, we also have bank, and we know that bank is also an asset, and assets decrease on the credit side. So we're also going to put minus 28,000 Rand. But where are we putting it? We're also putting it on the asset side. So on the asset side, you can see we have plus 28,000 Rand for the equipment and minus 28,000 Rand for the bank. And you can see it's still making sense. Our asset still equals equity plus liabilities. So you always pay attention to the details here. It may only affect one aspect, either assets only or equity only or even liabilities only. So you just pay attention to your information, and you need to know which one it affects for you to be able to do it well. Let's move on to our 8th transaction. Now obviously before we do that, you can see we're running out of space here. So I'm just going to remove the first 6 transactions and leave the 7th one there, and then we can move to our 8th transaction. We are told that the cash sales of inventory was 25,000 Rand, markup was 30%. Now here we sold inventory for 25,000 Rand and it had a markup of 30%. Now what do we have to do with the markup? Well, remember I said with every sale of inventory we have at least 2 transactions, and that is using the perpetual inventory system. Okay, so we're going to have those 2 transactions. The first one is to record the sale of the inventory. Well, it was a cash sale, so our bank is going to increase, and we put it on the debit side. Remember, our bank increases on the debit side, so we put the bank. And what is the account credited? Well, whenever we sell our inventory, our account credited is our sales, so we put that down. And what is the amount here? Well, we are told that the cash sale of inventory was 25,000 Rand, so that's an easy one. So we put plus 25,000 Rand on the asset side because our bank is increasing, and then we also put plus 25,000 Rand on the equity side because sales is an income which increases our equity. Now that we have done that, we need to move on to the second one. We have the cost of sales and the inventory. Remember, that is the second transaction you do with the perpetual inventory system. So we put the cost of sales, and the second one that we put down is the inventory. Remember, we put it on the credit side because inventory is leaving our premises, and inventory is an asset. It decreases on the credit side. So put inventory there. But what is the amount this time? Well, we want the amount that we paid for those inventory, or how much we bought those inventory for. Well, how much is it going to be? Well, here now we are dealing with the markup. We have done a lesson specifically on that where we looked at markups versus margins, but here's how we'll calculate how much we bought it for. Since this 25,000 Rand is already including the markup of 30%, we just want the 100% without the markup. So it's going to be 25,000 Rand that we are given times 100 divided by 130, and 130 being 100 plus 30%, and then we get 19,231 Rand. So we'll put that on the asset side as a negative. So we'll put negative 19,231 Rand. Obviously, we just rounded it up. And then on the equity side, we put negative 19,231 Rand for the cost of sales. So the one we put on the asset side as a negative is for the inventory leaving our business, and the one we've put as a negative on the equity side is for the cost of sales, which is an expense which decreases our equity. Okay, I hope it has made sense. Let's move on to the 9th transaction. We're told here that we borrowed 25,000 Rand from Egor Bank. So if we've borrowed money from the bank, what is happening? Well, we know that our bank account is increasing because that money came to us. We borrowed it. So we're going to debit our bank because money is increasing in our bank, and we're going to credit our loan or our bank loan because our bank loan is a liability, and liabilities increase on the credit side. And now that we have done that, we just need to put in the amount. Our asset is increasing because our bank just increased by 25,000 Rand. So we put plus 25,000 Rand on the asset side. And our liabilities is also increasing because we're owing more because we took this money from the bank by borrowing it. So we put plus 25,000 Rand on the liabilities side. And we've just finished number 9. Let's do the last one, which is number 10. We are told here that we purchased a vehicle for 100,000 Rand. A deposit of 25,000 Rand was paid, and the remainder would be paid in installments commencing in 2021. Okay, so we have a lot of details here. The first thing that we just note here is that we purchased a vehicle for 100,000 rand. So we know a vehicle is an asset, and assets increase on the debit side, so the account debited here is going to be vehicle. And then the second account we have here, well, we are told a deposit of 25,000 rand was paid. That means our bank account is reducing by 25,000 rand. So that's the second account, and it's credited because money is leaving our bank, so we put account credited as bank over there. And then we have a third account here. We are told that the remainder would be paid in installments commencing in 2021. So that means for the third one, we took car finance, or we took a loan. So we're going to put there a car loan, or you can just put it as a loan. That is the second account which is credited. I hope it's making sense, but we'll see just now as we put in the amounts. So our vehicle is increasing by how much? It's increasing by 100,000 rand, and a vehicle is an asset, so we put plus 100,000 rand on the asset side. And then what is happening to our bank? Our bank is decreasing by 25,000 rand because we paid the deposit of 25,000 rand. So we put minus 25,000 rand on the asset side for the bank. And then what else is happening? Well, we have a car loan here. We took out a loan for the remainder. Remember, we bought the vehicle for 100,000 rand. We paid 25,000 rand. So 100,000 minus 25,000 is 75,000 rand. So we still owe 75,000 rand. That's a liability, so we put it down as car loan, or you can just put it as a loan. So we put there 75,000 rand. And for the 10th transaction, you can see on the asset side we have plus 100,000 rand minus 25,000 rand, which gives you a sum of 75,000 rand. And then you can see on our liability side we have 75,000 rand. So our assets still equal our equity plus our liabilities. And that is how you do the accounting equation when you have the two extra columns of the account debited and the account credited. I hope this one has made sense. I hope you now know the accounting equation in great detail and how to complete it when you have debits and credits. If you have gained value from this lesson, please subscribe to our channel, like this video, and share it to those you think it might help. Till next time, cheers.